If you're currently in the market to buy a house, I'm going to answer the question today that I'm pretty sure most people have been struggling with over the last 12 months or so with this current crisis. And that is, should you take advantage of the extremely low interest rates right now, historically low, with the long-term fixed option, or should you wait for a slowdown in prices or even a reduction, or as many experts are calling upon, including myself, in the future, a property crash? And I have to tell you, I've been in the property sector for over 15 years. I own multiple agencies, and some people consider me somewhat of an expert in the housing market. And even I was surprised by the results from the analysis I'm about to go through with you. And another reason I'm so interested in this topic today is because I'm actually in the same position as you are. I'm considering right now whether or not to change my family home. And this is despite all of my models and all of my forecasts telling me that we're going to see a housing reduction in the near future. And unlike some of the other YouTube housing market videos and forecasts that are available right now, in this video, I'm going to focus not just on the USA or the UK or Canada or some of the other countries I've seen. I'm going to make this evergreen or universal so that it doesn't matter which country you are in, this video and analysis will apply to you. So just make sure you stay until the end of this video, where I'm actually going to go through my summary, talk about the analysis that we've done, and then give you my opinion on what I would do were I in your position, which I am. Before we can even get into any of the analysis today, we first have to go over the foundations and ascertain why exactly housing prices are going up so rapidly over the last year, when some experts and forecasters actually predicted that housing market would crash last year. And I've got to put my hands up, I was one of those people who thought the housing market would go down last year. And I still think it would have done if the different governments around the world didn't extend all the unemployment, the furlough programs. But the biggest fundamental we can say of all was all of the new money creation. In the USA alone, many of you may know that about 40% of all the dollars in existence were created last year. This is what we know as stimulus. We're now seeing more and more stimulus, another $1.9 trillion just passed in the United States. And let's get on to the first point then. What this actually does when you add more and more money to the money supply, it expands asset prices. So the reason your house, or maybe you don't own a house right now, but you've seen other houses, the reason they're going up in value so much is because a lot of this stimulus money ends in the banks again, in the banking sector. And what do banks do? What's one of their main sources of income? Is making loans. So that is mortgages, business loans, etc. But if we just focus on the mortgage aspect here, the banks are making lots of mortgages. And the more money that comes into their accounts, they want to get that out and make more and more mortgages. So this is why all of this money is coming in and it has to go back out again. So it's causing asset prices, not just the housing market, but the stock market, cryptocurrency, all sorts of other markets to expand. Now, if this didn't happen, if all this new money creation didn't come into existence, we didn't have the furlough, the mortgage forbearance, rent moratoriums, all of these programs that the government has enacted, if this wasn't in place against the backdrop of the highest unemployment we've seen in a long time, against the backdrop of a lack of interest and participation in the labour market, very heavy personal debts, bankruptcies, companies going bankrupt. If the government didn't get involved and do all this, we would definitely be in a housing decline right now. But there's one other important point that I want to mention firstly, and that is that I'm seeing a lot of housing market experts, in fact pretty much all of them, saying that we are in a seller's market right now. And although that's true, there's actually more to it than that. I would say that we're also in a buyer's market. So we're in both a seller's and a buyer's market right now. So why is that? Well, it's because, firstly, with the seller's market, there is not enough inventory to meet the demand of the buyers. So we haven't got enough houses on the market to meet the demand of all the buyers. And of course, we have the low interest rates, the long-term interest rates, so people can lock in for a long time. So it's created this excess demand in the marketplace. But what else have we got? We've also got a buyer's market for the exact same reasons. Buyers haven't had the option of getting such low interest rates on sometimes 30-year fixed. Even in the UK, there's now a new mortgage for a 40-year fixed rate mortgage. These things just haven't been available for a very, very long time. Imagine if I said to you a couple of years ago, in 2021, you will be able to get a 30-year fixed rate mortgage for 3%. You'd have looked at me and thought I was mad. And yet here we are today where you can get rates like that on such long terms. But this doesn't come without its risks, because the last time I saw very low interest rates was around 2004 to 2007 sort of period. And you know what happened in 2008? We went into a market crash, which became known as the Great Recession. But both of these fundamentals really are why I see so much danger in the current housing market. So before I go into the analysis then, I'm just going to put it on the black background behind me here. I just want to cover off the short-term and medium-term fundamentals. It's really important that you understand if you want to understand the housing market and know what to look out for. And if you could do me a quick favor at this stage in the video, please just click the like button below. And if you're not subscribed to the channel, why not subscribe? I keep you up to date whenever I see changes in the markets. Okay, let's start with the short term then. And I'm going to say this is between now and the next 12 months. So we have a few points here. Firstly, I've already covered it. It's all the new money creation going into the economy. The second point is that a number of governments have programs like now. The USA has just announced a $15,000 bonus payment for any new homeowners. You can buy a new home and get this $15,000 payment towards it. The other point I've also already covered, that's low interest rates. These are the things that are helping to keep house prices high. Number 4, low inventory, keeping prices high. And then number 5, this is the sort of wild card here that I've been talking about for the last 9 months now. And that is jobs, migration, and remote working. So what we're having then is people are needing bigger houses right now, because a house isn't just a home anymore. It's also an office, it's a school for the children, and it's somewhat leisure as well, because a lot of countries are now coming out of lockdown, but there's still a lot, especially in Europe, who are still under extremely strict lockdowns where people, they can only go out for essential purposes like going to the grocery store. So the other thing people need is an outdoor space, so a large garden or yard, or somewhere they can walk around or relax. Or people who are in the city or in apartments, a lot of people are moving out to the suburbs and more rural so they can get more nature and things like that. Because one of the patterns that's emerged in this crisis is that people have missed being out in nature and not being able to get that. So we are seeing this mass migration and all these fundamentals which people are needing. That's why people are moving upwards in terms of their housing. But if we switch track now to the medium term, so this is the next 1 to 3 years, I would say, these are some of the fundamentals that I believe may bring the housing market down. So the first one then is forbearance ending, or unemployment benefits in the US and other countries you call it. Property taxes and foreclosures, some of these are coming about. People are very far behind. We've got a lot of delinquencies. These things will come to the forefront unless the governments just keep kicking this can down the road and delaying and delaying and delaying. We've already seen several extensions to these programs, and some pundits believe that this is just going to keep going on, especially with the unemployment benefits as well. A lot of people are now talking about this UBI, Universal Basic Income, to replace unemployment benefits at the end of all of this crisis. Of course, the other thing is the mass migration finally coming to an end. I think for certain we're going to see that in the next 1 to 2 years. At that point, anyone who wanted to move, I think will have moved by that point, especially if they've been waiting to buy. And if they watch this video, I think this will cement that for them and give them a firm decision on what to do. But I think the real nail in the coffin over the next 1 to 3 years, but it could even be this year as well in the next 12 months, is interest rates rising. We've already seen mortgage rates going up very slightly over the last few months, as was forecast, so that was a fairly accurate forecast. And I do believe that we're going to keep seeing some more rises in interest rates. Now, in a normal situation like this, these rises in interest rates would pull down house prices very slightly, but I believe that won't happen for at least 6 months. I'd say definitely the next 6 months. Past that, I can't really forecast right now until I start to see what's going on with other fundamentals in this marketplace. I don't think that house prices are going to come down as interest rates go up, because there's just too many opposing forces on the opposite side that are still pulling house prices upwards. So let's get into the analysis now then. All right, let's start with the average house price then, and we'll say that's $250,000, and we'll use dollars, but you can say pounds or euros, whatever for your currency. I'm also going to assume that you're going to put a 20% deposit down, so that means that you're going to put $50,000 down, taking your total mortgage to $200,000. I'm also going to assume that you got a 4% fixed rate for, let's say, 30 years. I'm recommending at the moment that people get the longest fixed rate they possibly can. I'm not sure why so many mortgage advisors are telling people to get shorter than that, so they can get another 1% off. I saw someone the other day recommending, don't take 30 years, just take 3 years because you'll save 1%. Ridiculous guidance there, ladies and gentlemen. Get the longest you possibly can for the mortgage as a fixed rate. So here's the numbers then. If you were to buy today and you got a 4% mortgage, your monthly payment, and again, I'm not including HOA and insurance and all these other things, would be $1,438. In a year, that would be $17,258. And by the end of the full 30-year term, you would have paid $517,739. Now, if we move over to the other side and you're waiting right now, this will just say NA because nothing's going on. You're just waiting to see what happens in the marketplace. So now let's take it 12 months later on, and let's just say that there was a price drop of 20%. Now, I think this is unlikely in the next 12 months. I definitely think in the next 6 months that we're going to see increasing house prices, unless a number of the fundamentals I touched upon and also covered in my other housing market videos, I'll just put a link up above so you can watch those. If some of those fundamentals all hit at the same time, then this could actually reverse the housing market and cause it to start going downwards. But this would be a worst case scenario of all these things occurring at once. So let's just say then that things have gone bad, and in 12 months' time, prices have dropped by 20%. Well, again, we're going to use the same numbers on the left column here, and that is the 4%. You're still paying the exact same rates as you were before. There's no difference to you either way, except that your house has lost $50,000 in value. That's the only difference. Now let's go over to the other side and say that you decided after 1 year to make that purchase. Now the house that was $250,000 a year before is now $200,000. You still put down your $50,000 because you had your $50,000 deposit, so you're still going to put that down, which takes the mortgage down to $150,000 now. But interest rates have gone up by 2% during this period, which I think is certainly possible as we're seeing the rates changing right now. So obviously having a higher interest rate, even though it's the same term, 30 years, will change the numbers slightly. So rather than a $1,438 monthly payment, it's actually a little bit lower. It's $1,382 per month. Per year, $16,592. And over the term, over the full period, is $497,000. $757. So that is the numbers if you were to wait a year based on those fundamentals. Now let's say it was 2 years later now, so we're adding another year to the timeline, and actually there was a housing crash. And let's just say it was a 40% crash, similar to the '08 crisis and the Great Recession, and it was a 40% crash this time. What would happen? Well, if you'd have bought 2 years previous, as we mentioned, there's still no difference at all. You got the 4%, the $1,438 per month, etc., etc. There's no change to you except that you've now lost $100,000 worth of value and you're underwater on the mortgage. So the house is actually worth less than you have on the mortgage. Flip over and let's say that you waited 2 years to buy, but now it's not a 4%, it's not a 6%, it's actually an 8% mortgage. But you're only paying $150,000 for the same house that was $250,000 previously. You put your $50,000 down as your deposit again, so your mortgage is only $100,000 now. Wow, that sounds great. Your monthly payment is $1,217, annually is $14,605, and over the term of the loan, it's $438,155 total repayable. So already just looking at these two comparisons here, the total repayable on the left was $517,739 and on the right is $438,155. So if you compare the two, then the 4% versus the 8%, obviously the 4% was a $200,000 mortgage, the 8% is a $100,000 mortgage. It's quite interesting when you look at the total amount payable. With the 4% it's $517,739. With the 8% it's $438,155. So there's a difference there of about $80,000 that you would pay more by having bought right now, and versus $80,000 less if you were to just wait a couple of years, assuming there was a 40% correction. And that's a big assumption. But I think what we've done right here is probably enough for us to go into the analysis. So let's look at over the next 1 year then. I think it's pretty obvious which is the clear winner. And this is even without the price rises. I think that house prices are going to go up over the next 6 months. So adding that to what we've already done here, you've also got the gains as well. So the 12-month period, the next year, is the clear winner to buy right now. If you're just looking out the next 12 months, the next 1 year, clearly the winner here is to buy right now, lock in this low interest rate and get the equity rises on the home. But now let's look 1 to 3 years out, and we're going to just assume that there's a 20% crash in the next 1 to 3 years. So let's just make that assumption. It's pretty even. So whether you buy right now today and get the low rate interest rate and all the other things that we talked about, but there was no growth, there was a 20% crash, versus waiting 1 to 3 years is about even when you look at the costs, which actually surprised me somewhat. But if house prices continue to go up over the next 1 to 3 years, then again, buying right now is the clear winner. So you've just got to think, what do you think is going to happen as we go through the next 1, 2, 3 years? And then as we go into the 3 to 5 year, which is the more longer term forecast, if we just assume that there's going to be a 40% correction, and again, you have to make a decision whether you think this is going to happen or not. So we assume there's a 40% correction. At this point, if you'd have bought when we first said with the 4% interest rate, then you would not be the winner in this scenario. It actually flips over to those who wait the longer period, the 3 to 5 years, and they purchase with the 40% decline in prices. That's where it flips over to those who wait. But if there wasn't a crash again, the clear winner would be buying right now with the long-term fixed rate interest rate. So I promised at the end of the video, I would tell you what I would do if I were in your situation, and actually I am in your situation right now. If I desperately needed to buy a home right now, because of any of those fundamentals we mentioned, the migration, needing a home office, schooling children at home, there's absolutely no doubt in my mind that I would buy right now. I would definitely make the purchase right now, get that 4% loan, lock it in for 30 years, and even if the housing market did crash or correct, it doesn't really matter because it's non-investment to me, it's my family home, and I'm going to hold it for the next 20, 30 years. But if I thought I was going to move in a few years' time, I probably wouldn't buy it now, because in a few years' time I would need to get a new mortgage. It's very unlikely that you're going to be able to transfer it over, so I'd need a new mortgage, and the rates are going to be a lot higher. So that is the only variable there. But in my position, I'm not in a rush right now to buy, and I am quite confident that there will be a correction, there will be a crash in the housing market. I just can't tell you exactly when, because of the government fiscal policy, the Federal Reserve monetary policy with other central banks. They keep changing the goalposts. It's like kicking a ball into a goal and someone picking up the goal and moving it backwards. There really isn't any way to tell when the crash will come about or the correction, because of all the new money creation, which is artificially pushing up the prices. So in my situation, I'm going to talk it over with my wife. We're going to have to make a decision together as a family to decide what we want to do. So I really hope that helped you today with making your decision on what you should do right now in the housing market. Should you buy right now? Should you wait? Thank you so much for watching. Please click the like button if you haven't already. Definitely subscribe to the channel. And apart from that, God bless. Thank you so much for being online today, and I'll see you very soon.